Moves in the bond market this week. Investors looking for more safety than in stocks and more yield than offered by treasuries. Joining us now for some more detailed thoughts about the bond market, though, Stephen Nash, joining us from Fixed Securities. Stephen, good to have you on board, and Carson's, of course, still with us as well to ask a few questions also. A big discussion at the moment is surrounding the Australian banks and their funding pressures at the moment, basically. Just give us some thoughts, though, on the kind of the economic backdrop to all of this. Globally, you've been looking at the Dodd-Frank Wall Street Reform Act. Just tell us a bit about it, firstly, to remind us, and then, you know, how you think that's actually going to impact economic growth, if it will have an impact. Well,
there's been quite a few changes that are forecast to be introduced. The Senate still has to approve the bill, but there's a ban on proprietary trading, which has been very important for many of the US banks. There's a trimming of the amount of derivatives that banks can do. The more exotic derivatives, where the banks made quite considerable profits, are now they're not going to be able to trade those. So generally, I think the effect will be extra costs coming through to the consumer at some point, and effectively acting like a monetary policy tightening in the medium term, not immediately, but the market will be looking to assess the effect of this right now, and it's continuing to assess the effect of this, yeah. And you talk of the impact on the consumer because what banks then will lend less as well? I mean, in terms of credit availability, which is so important. Yeah, I think it will impact bank profitability quite a bit, and therefore I think the banks will be less willing to lend and restrict credit to some extent, yeah. And you're talking the global banking system, so including extending out to us here in Australia. How will we eventually be impacted? Well, I think there'll be further moves to regulate the Australian banks. However, that will really depend on the growth outlook. If the growth outlook was to contract, then I imagine the authorities will extend the period of introduction of these measures. For example, the liquidity measures that APRA are looking at may be implemented a little bit more slowly than people were expecting. In terms of us here in Australia as well, we're watching these bank stress tests in the United States, and again, this is the global backdrop for what we're watching for our own banks. Yeah. Do you see value in these stress tests? What are they expected to reveal? I think... Why the smile? Look, well, I think the stress tests are important, and they were important in the case of the US. You might remember when they did them in the US, the banks started to rally, and it was really the turning point in the market. I think what the market at the moment is trying to do is anticipate a similar situation where the European banks come out with those stress tests and the market basically rallies off that. Now, there seems to be a lot of debate about the type of the stress test and the factors that are going to be used, and there's the typical political rows that are going on behind the scenes. And I think when these results come out, they mightn't be as clear as people are expecting or demanding, and that may cause further problems.
Yeah. Okay, what breaks this logjam, though, of banks' willingness to lend to each other? When you get those results, does it break the impasse? Because LIBOR touching a 10-month high overnight, it's not signalling that confidence levels are improving at all. Are these tests going to be the catalyst?
I think it's hoped that they will be the catalyst. I'm not so sure that they will be the catalyst. I think that
what will be the catalyst, but from where you sit?
I think there may be moves after these stress tests are released to revise them and give more clarity. You could see in the case of the Greek debt crisis how the authorities reacted very slowly, and there was a lot of debate, and the market got a bit carried away, and eventually there was a resolution. So I imagine a similar situation will occur with regard to the bank stress test. So you feel it does turn around the sentiment, though, but broadly, I mean, sentiment is so negative at the moment. How much of that do you think is about the European banks? As in, will that kind of resolve the sentiment issue if we get to... Well, I think, as I was alluding to, I think it's partly regulation that's kicking in after the crisis. Yeah. So it may not change anything in the end. Well, there's other factors that are coming in. Apart from the banking situation, this reaction, in terms of the regulatory reaction, is good, but the problem is it's affecting growth perceptions, and I think right now growth perceptions are the thing that are really important. Damaging those perceptions is probably not the right way to go.
Really happy that you mentioned that, Stephen, because let's bring it back to Australia and the outlook on rates as well, because Warwick McGibbon from the Reserve Bank, the board member as well, on that one. Yesterday was talking about the importance of China, saying that despite what was happening in Europe, he had confidence that China would pull through this. You could almost say he was an advocate of decoupling, although he didn't quite go down that route.
Yeah.
Now, it seems that he would therefore show every willingness to vote for a rate rise in August if CPI is elevated. Do you agree with that? What's the market saying?
At the moment, the market's not going for a rise in August. I think there will be an elevated level in the CPI. I think the RBA has already flagged that they're concerned about utility price inflation, but that's not really something that's relevant for their consideration. So there might be a willingness to overlook those figures that come out in late July. It really depends on your view on growth expectations around that period. And I think my views at this stage are that there will be continued concern about growth.
Enough to derail the global recovery, or will China's continued traction offset it?
Well, I think it will be sufficient to not force a tightening, put it that way. So I imagine that, you know, the Chinese story that is evolving in terms of a slower growth, not a recession, but just slower growth.
Moderating.
And then the global story will be still quite volatile, and I think that probably will be enough for the
to force their hand, even if underlying CPI is at like inflation's at 4%, so way outside their band, they would still sit tight.
I think at this stage, well, it depends on the extent of the CPI, but then again, that's a problem with the numbers. We don't have a quarterly number, so it can look quite large in the quarter. But then again, we don't have regular monthly releases, although we have the TD Institute, which recently came out and did indicate slightly elevated levels. And I think it really depends on the perceptions of growth going forward.
And just literally, as one last comment, I mean, bring it back to the banks. Talk about the RBA having its hand forced. What about the banks? The funding costs, you know, you're talking about the European situation and the global economic outlook. Are they going to be forced to raise rates outside the RBA moves?
Well, we spoke about this last week, and we've done further work on it, and it appears as though if long-term funding rates were to widen, and I think they might, another 40 basis points, that should translate into a rough increase of 25 points for funding, and therefore that should be passed on.
Likely, so, and it's likely to be?
Yes, there will be arguments, I suppose, for the RBA to offset that.
To cut.
In order to offset that increase, but I imagine the RBA will probably not go that path.
Good stuff. And Terry McCrann was making that comment last night on the Business Channel that the RBA might end up being forced to cut itself. Stephen Nash, great to have you from FIG.
Thanks very much.
Plenty of discussion left to have with you next time, and Carson Scott with me in